High dividend yields can be tempting, right? I used to think they were the key to quick income from my investments, but after diving deeper into the world of stocks, I realized that chasing high yields can be risky. In this video, I'll explain why I shifted my focus and why you might want to as well. High dividend yields can be incredibly attractive, especially for new investors. The idea of earning a significant amount of money just by holding onto a stock is appealing. It feels like getting paid to do nothing. You see a stock with a 7, 8, or even 10% yield, and it seems like a no-brainer to invest. After all, who wouldn't want a guaranteed return that high? The lure of high yields is even stronger when you compare them to other investment options. Savings accounts and bonds often offer much lower returns, so a high-yield stock looks like a goldmine. Many people, including myself, get drawn into this thinking early on. It's natural to want the highest return possible for your money. Another factor that makes high dividend yields appealing is the sense of security they can provide. Dividends are often seen as a sign of a company's financial health. If a company can afford to pay out high dividends, it must be doing well, right? This assumption can make high-yield stocks seem like a safe bet, especially when the market is volatile or uncertain. However, there's more to the story. High dividend yields can sometimes be a red flag. A yield that's significantly higher than average might indicate that the company is struggling. It could be that the stock price has dropped due to poor performance, and the high yield is just a byproduct of a low share price. In such cases, the high yield isn't a sign of strength, but rather a warning signal. Additionally, companies that pay out very high dividends may not be reinvesting enough back into their business. This lack of reinvestment can hinder growth and future profitability, making the company less stable in the long run. High yields can also lead to unsustainable payout ratios, where the company is paying out more in dividends than it earns in profits. This situation isn't sustainable and can lead to dividend cuts or suspensions, which can hurt investors. Understanding these risks is crucial. High dividend yields can seem like a fantastic deal on the surface, but they come with hidden risks that many investors overlook. Let's dive into some of these risks and why they can be detrimental to your long-term investment strategy. Firstly, high dividend yields can signal financial distress. When a company's stock price drops significantly, the dividend yield rises. This might make the yield look attractive, but the drop in stock price could be due to underlying problems within the company. For instance, declining sales, increasing debt, or management issues can all contribute to a falling stock price. Investing in such companies can be risky because the problems that caused the price drop might worsen, leading to further declines in both stock price and dividend payments. Another risk is dividend cuts. Companies with high dividend yields often have high payout ratios, meaning they pay out a large portion of their earnings as dividends. This can be unsustainable, especially if the company faces financial challenges. If earnings decline, the company may be forced to cut its dividend to preserve cash. When a company cuts its dividend, it often leads to a sharp decline in its stock price, resulting in a double hit for investors: reduced income and a loss in capital. High dividend yields can also lead to complacency. Investors might focus too much on the income they receive from dividends and ignore the overall performance of their portfolio. This can be dangerous because it can lead to holding on to underperforming stocks for too long. In the worst-case scenario, the value of your investment can erode significantly, and the high yield you once enjoyed may no longer compensate for the losses. Additionally, companies that pay very high dividends may not be investing enough in their own growth. Reinvesting profits into research and development, expanding operations, or paying down debt is crucial for a company's long-term success. By prioritizing high dividend payouts, a company may sacrifice these important investments, leading to stagnation or decline. In the long run, this can hurt the company's ability to generate profits and continue paying dividends. Another hidden risk is that high dividend yields can attract income-focused investors who may not fully understand the company's fundamentals. This influx of investors can inflate the stock price temporarily, creating a bubble. When reality sets in and the company's issues come to light, the stock price can plummet, leaving investors with significant losses. Lastly, focusing too much on high yields can lead to a lack of diversification. Income-seeking investors might concentrate their portfolios in high-yield stocks, neglecting other important aspects like growth potential and sector diversification. A well-diversified portfolio is essential for managing risk and achieving long-term investment success. High dividend yields can be part of a diversified strategy, but they shouldn't be the sole focus. While high dividend yields can be tempting, dividend growth stocks offer a more sustainable and potentially more lucrative path for long-term investors. Let's explore the benefits of focusing on dividend growth stocks. First, dividend growth stocks provide reliable income that increases over time. Companies with a track record of growing their dividends are often financially stable and have a strong commitment to returning capital to shareholders. This means you can expect your income to rise steadily, helping to combat inflation and increasing your purchasing power over the years. For example, a company that raises its dividend by 5% annually can significantly boost your income over a decade. Another benefit is the compounding effect. When you reinvest dividends from growth stocks, you buy more shares of the company. As these companies continue to grow and increase their dividends, you receive more dividends from the additional shares you've accumulated. This creates a powerful compounding effect where your investment grows exponentially over time. It's a classic case of letting your money work for you. Dividend growth stocks also tend to be less volatile than high-yield stocks. Companies that consistently increase their dividends usually have stable earnings and a solid business model. This stability makes them less susceptible to market swings and economic downturns, providing a smoother ride for investors. While no stock is completely immune to market fluctuations, dividend growth stocks often weather storms better than their high-yield counterparts. Additionally, companies that focus on dividend growth are often well-managed and have strong business fundamentals. They prioritize sustainable growth and prudent financial management, which are key indicators of a healthy company. These companies are less likely to engage in risky behaviors or overextend themselves financially, reducing the risk of dividend cuts or financial distress. Dividend growth investing also encourages a long-term perspective. When you focus on companies with a history of growing their dividends, you're less likely to be swayed by short-term market movements or quarterly earnings reports. Instead, you can focus on the bigger picture and the steady growth of your investment over time. This long-term mindset can lead to better investment decisions and greater financial success. Moreover, dividend growth stocks can offer attractive total returns. While their dividend yields may not be as high initially, the combination of capital appreciation and increasing dividends can lead to substantial gains. Companies that grow their dividends often experience rising stock prices as well, providing a double benefit of income and capital growth. Finally, focusing on dividend growth stocks can help you build a diversified and resilient portfolio. Dividend growers are found across various sectors, including technology, healthcare, consumer goods, and more. By investing in a range of dividend growth stocks, you can reduce your exposure to any single sector or company, spreading risk and increasing the likelihood of stable returns. So, while high dividend yields can be alluring, dividend growth stocks offer a more balanced and sustainable approach to building wealth. They provide increasing income, stability, compounding benefits, strong fundamentals, and attractive total returns. To create a strong, balanced dividend portfolio, diversification is key. This means spreading your investments across various sectors and industries. By doing this, you reduce the risk of any single sector dragging down your entire portfolio. For example, combining tech stocks like Apple or Microsoft with consumer staples like Procter & Gamble ensures that you're not overly reliant on one industry. Next, mix high-quality dividend growth stocks with a few reliable high-yield stocks. This blend provides a steady income stream while also allowing for significant growth over time. Remember, the goal is to find a balance between immediate income and future growth potential. Consider using dividend-focused ETFs for added diversification. Funds like the iShares Core Dividend Growth ETF, DGRO, or Vanguard Dividend Appreciation ETF, VIG, offer exposure to a wide range of dividend-paying stocks. These ETFs can be a solid foundation for your portfolio, giving you broad market coverage with less individual stock risk. Another important aspect is regularly reviewing and rebalancing your portfolio. This means checking in periodically to ensure your asset allocation aligns with your investment goals. If one stock or sector has grown too large, consider trimming and reallocating to maintain balance. Make sure to keep an eye on the payout ratios and financial health of the companies you invest in. A sustainable dividend is better than a high dividend that might get cut. Look for companies with strong cash flows and a history of increasing dividends. Building a balanced dividend portfolio takes time and research, but the rewards of a well-structured portfolio can provide financial security and growth for years to come. Now that you understand the benefits of focusing on dividend growth stocks, let's talk about some actionable steps you can take to get started on this investment path. First, research and identify strong dividend growth stocks. Look for companies with a long history of consistently increasing their dividends. You can find this information on financial websites, in annual reports, or through investment research platforms. Focus on companies with strong fundamentals, stable earnings, and a solid track record of financial health. Next, diversify your portfolio. Don't put all your eggs in one basket. Aim to invest in dividend growth stocks across different sectors and industries. This diversification helps spread risk and increases the stability of your income stream. Consider including companies from sectors like technology, healthcare, consumer goods, and utilities. Once you've identified a list of potential stocks, set up a regular investment plan. Consistency is key when it comes to dividend growth investing. Decide on a fixed amount you can invest each month and stick to it. This approach, often referred to as dollar cost averaging, helps reduce the impact of market volatility and builds your portfolio over time. Another important step is to reinvest your dividends. When you receive dividend payments, use them to buy more shares of the same stocks. Many brokerage platforms offer automatic dividend reinvestment plans, which make this process seamless. Reinvesting dividends accelerates the compounding effect and enhances your long-term returns. Stay informed and review your portfolio periodically. Keep an eye on the performance of your dividend growth stocks and stay updated with any changes in their dividend policies or financial health. Adjust your portfolio as needed, but avoid making impulsive decisions based on short-term market fluctuations. Be patient and maintain a long-term perspective. Dividend growth investing is a marathon, not a sprint. It takes time for the compounding effects to show significant results. Trust the process, stay committed to your investment strategy, and watch your income grow steadily over the years. By following these actionable steps, you can build a robust dividend growth portfolio and achieve your financial goals. Now that you're set with dividend growth stocks, let's take it a step further. You can supercharge your compounding effect with stocks that pay monthly dividends. That is exactly what we'll talk about in this next video. Don't miss it. This could be the game changer you need to maximize your investment returns. Click on the next video to learn more.